Hi, everyone, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Just a quick note that anyone who has registered for today's program will be receiving a copy by the end of this week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Today, we welcome back our dear friend, founder, and managing director of Kerrigan Advisors, Kerrigan. Erin, I always look forward to your presentations and know you have a lot to get to today, so I'll let you have the floor.
Thank you. And thank you, AIADA, for inviting me to do another webinar on the auto retail buy-sell market. I have to say, when we chose this date, I did not know we would be in the midst of historically uncertain times in the U.S. automotive industry. So with that in mind, to discuss the market today, I'm going to recap where we stood at the end of 24, and then talk about some key trends and expectations for 25, knowing that much of this could change based on the Trump administration's tariff policy. All in all, what I will share with you that as we stand today, we have not seen, Kerrigan Advisors has not seen a big impact from the announcement of tariffs to the buy-sell market, with most dealers projecting that Trump will strike a deal by this summer, or as Bernie Moreno said last week, this will all be a blip that we forget about in the not too distant future. Let's hope so. Okay. Before I get started, for those who are not familiar with our firm, Kerrigan Advisors is the leading sell-side advisor in auto retail. We've sold 285 plus dealerships on behalf of our clients, raising over $9 billion in the last 10 years. And we attribute much of our success to the fact that we are the only firm in auto retail exclusively dedicated to sell-side advisory. What this means is that we are conflict-free, laser focused on achieving our clients' personal and financial goals in a sale. Of course, we still spend a great deal of time getting to know buyers, their investment criteria. However, our fiduciary responsibility is always to our clients, the seller. We like to say, others have conflicts, we have your interest. With that brief commercial, I thought it only appropriate to employ a Trump theme to today's presentation. He certainly is the man of the hour. Like Trump, today's buy-sell market has been full of surprises, particularly in its ability to continue to hit new records. In 2024, the buy-sell market achieved yet another record, growing 11% from 23's highs. 438 buy-sells were completed, including one of the largest private transactions in auto retail history, the sale of Kerrigan Advisors client Leith Automotive to Holman, which was a 28 franchise deal. For the year, 697 franchises were sold, the highest level since 21. The strength of the buy-sell market last year was a product of growing industry confidence in future auto retail revenue and profitability. As vehicle affordability improved, that's the dark blue line, largely due to lower interest rates, new vehicle sales rose considerably in the second half of the year, strengthening buyers' confidence. This confidence grew even more robust post-election when dealers experienced a significant rebound in new vehicle sales. For many, this was clear evidence of pent-up consumer demand after years of constrained supply. It is estimated that about 11 million vehicles went unsold between 19 and 24. The abundance of fourth quarter sales last year was an indication of a market with significant growth potential and the opportunity to return to the 17 million SAR from which the industry came. It's important for us all to remember that we averaged at 17 million between 2015 and 2019. So the possibility is definitely there. Auto retail also appeared to be entering earnings stabilization in 24. Buyers were increasingly projecting earnings growth for 25 after years of decline, seeing 24 as the earnings trough. That was the buzz that we heard at NADA. And I will say gross profit per vehicle also seemed to be stabilizing by the end of the year at levels much higher than what we saw before the pandemic. In fact, even on an inflation adjusted basis, which is the red line on this graph, grosses were still 38% on average higher than they were pre-pandemic in 2019. Now, to many industry observers, the pent-up demand of about 19 million vehicles combined with sustainably high grosses meant that the industry had a $40 billion gross profit wind at its back. And with this positive perspective, average dealership valuations were sustaining historically high blue sky values last year, albeit lower than their peak, about down 19-20%, but still 70% higher than 2019 levels. Now, to be very clear, this is average. So we certainly have franchises that are trading well below 19 levels, think Stellantis, and some trading more than double 2019 levels, think Toyota. As we sit here today, the jury is out on where valuations go by the end of 2025. Much, of course, does rest on how this tariff policy settles out and interest rates. However, based on current deal activity at our firm, I do not expect a decline in values in 2025. Okay, now that we've discussed the 24 buy-sell market, let's look at the market from both the buyer's and the seller's perspective, starting with the buyers, many of whom are still actively stacking up stores, unfazed by market uncertainty. The consolidation trend ignited by the pandemic-induced surge in industry earnings is continuing from our perspective in 25. And this is largely because our industry remains very well funded. Kerrigan Advisors estimates auto retailers have amassed nearly $250 billion of pre-tax earnings in the last 4 years, nearly 2.5 times the level they achieved the 4 years prior. Many of these dealers want to put their capital to work and are actively seeking acquisitions, even with the tariff risk. Particularly, by the way, the largest dealership groups. In 24, the top 150 dealers grew their buy-sell market share by 31%, while smaller privates' share shrunk 10%. Increasingly, we find dealers are finding scale to be a differentiator, not just in the way they operate their business, but also in how they acquire stores. Well-capitalized buyers are often crowding out smaller acquirers because they are getting deals done with the staffing, the deal team, and the experience that they have to move quickly, and they don't have finance contingencies. And this is becoming a real differentiator, being prepared to grow, not just having the capital, but also having the whole team and the experience to do it quickly. The top 150 dealers are also leveraging their balance sheets to invest in proprietary technology solutions and changing the way they manage their business and sell cars. This, coupled with the dealership acquisitions they're doing, could serve as the greatest change agent to supercharge the top 150's market share, which has already grown to 1/3 of the industry in 5 years. Think about that. 150 dealer groups represent 1/3 of the sales in our industry. At this rate, the top 150 will at this growth rate that they've been growing at, they're going to represent the majority of the industry sales in 20 years' time. And that could be a tipping point when we really see a change when, again, just 150 dealer groups are a majority of sales in the industry. Now, while 20 years might seem like a long ways away, I like to say that dealers think in generations, not decades. So this is an important point for the next generation of car dealers as they think about their strategy. Now, a major contributor to the top 150 dealer group's revenue growth is their focus on growing sales per dealership by maximizing the use of data and also by acquiring the highest volume dealerships in the market. They very much look at volume when they're growing. As you can see here, there is a growing chasm between the NADA average sales per dealership, which has been pretty flat, and the top 150 dealers' average sales per dealership, which has risen 12% since 21. If this growth rate does continue, these groups will have the majority of the industry sales sooner rather than later. And what we find is that many of the buyers today want to make sure they are tracking to be a top 150 group if they aren't already. Now, in terms of who are the buyers within this top 150 group, interestingly, privates are far outperforming publics. Last year, private top 150 dealers, which is that turquoise red square, represented an incredible 28% of the buy-sell market and took advantage of the public's pullback in 24. In fact, last year, the 6 publicly traded auto retailers significantly reduced their activity, allocating just $1.6 billion to U.S. dealership transactions. Now, for 2025, Asbury did start off the year strong with the announcement of their $1.3 billion acquisition of the Herb Chambers Group. You can see that that's almost as much as the entire group of publics spent last year. And on one deal that'll likely close this year, that's covering most of what they spent last year. Most of us thought that this would kick off another mega year of deals for the publics with this February announcement, especially since the blue sky multiples of these publics had risen so much by the end of last year. You can see that this is the cumulative blue sky multiple for all of the publics, and they rose to an average of 7.7 times by the end of last year. This slide is very informative as to why the publics didn't do as many deals last year, because you can see that their combined blue sky multiple, their blended blue sky multiple, was below the top luxury and non-luxury multiples in the marketplace. So they were really priced out of deals for much of last year. And that's because these companies will not do a deal that is dilutive to earnings. So that really put a cap on what they could spend. But this situation dramatically reversed in the fourth quarter after the election, and the Kerrigan index soared to new highs, with 4 of the publics achieving record market caps. Unfortunately, once the tariffs were announced, there was a complete reversal, and all of the post-election valuation gains were lost. So keep in mind, Asbury announced the Herb Chambers transaction around the peak of the Kerrigan index. As a result of this pullback, many of the public's blue sky multiples have declined significantly in the last 2 months, which could put a damper on their acquisition appetite in 25. It is also important to keep in mind that transactions take about 4 to 6 months to complete, given negotiating time for contracts, due diligence, and of course, OEM approvals. When the public stock price declines, as they have been recently, we often see a reduction in their closings in the next 2 quarters. Even if their stock rebounds in those next 2 quarters, it takes time to get these deals done. It will be interesting to hear the public's first quarter earnings calls starting in a few weeks to see what their messaging is and if they are taking a more long-term view. But for now, this is certainly could be a damper on their activity in 2025. We will see. Okay, now that I've talked about where the buyers' heads are at, let's turn to the sellers, many of whom are ready to make a deal, especially given the current uncertainty in the marketplace. In our 2024 Kerrigan Dealer Survey, which is the first of its kind and the most robust of its kind, with over 600 dealers responding, much to our surprise, the number of dealers looking to sell one or more dealerships increased 258%. While those looking to add did increase, but at a much smaller percent. And in stark contrast, those looking to just stay with the course, steady state, declined by 12%. I think these results, frankly, really speak to the fact that inertia is no longer a good strategy in auto retail. Most feel they need to either grow their business, try and get into that 150 group, or start planning for an exit at some point, because the steady state will probably not be a viable option in the long run. And those who are looking to sell are seeking to capture strong values, as is evidenced by the tremendous growth in the buy-sell market share of the southern region of the US in 24, which reflected the majority, over 50% of the transactions that closed last year were in this southern region. In Kerrigan Advisors' experience, the premium prices that buyers are still willing to pay for dealerships in high growth, business-friendly markets has definitely caused many southern dealers to decide the time is right for an exit. Similarly, import dealers, both luxury and non-luxury, have captured a disproportionate share of the buy-sell market, with 24 being an all-time high. In many cases, the sellers of these top import stores are receiving blue sky offers that make an exit and retirement economically feasible sooner than they had really expected, and they don't want to miss their window to cash out it with big dollars. It is pretty remarkable, by the way, if you look at this graph, to see that import non-luxury franchises represent just 21% of the total US franchises, and yet they represented 41% of the buy-sell market share in 2024. That's a really disparate market share relative to their, disproportionate relative to their franchise market share. Now, one of the reasons we see more sellers coming to market today is because of real estate. Prime retail real estate, like the Trump Tower, is key to most dealership operations. Most of this type of real estate maintained near record valuations in 24 or record, defying the inherent pressure from prolonged higher interest rates. In addition, higher construction costs and replacement costs resulted in dealership appraisals exceeding both seller and buyer expectations in 2024. The scarcity of well-located dealership real estate is expected to uphold dealership property premiums in 25, as demand often exceeds supply. Since 2014, Kerrigan Advisors estimates that average dealership real estate values have risen to $13.9 million. Now, as a result, while average dealership blue sky values have declined about 20% from their peak, the rising real estate valuations have offset this decline, keeping total enterprise value near record levels. Of course, this assumes the dealer owns their real estate. This trend, by the way, underscores the increasingly vital role dealership real estate plays in a dealer's decision to sell, and frankly explains why most buyers insist on buying the real estate as well. But you can see that the real estate is really offset, such that many dealerships, when you include the full enterprise value, are trading at values far above their 21 levels and maintaining close to their 22 levels. Now, in many cases, we're finding that dealership real estate is also the reason dealers are choosing to sell, especially if an OEM is asking them to invest millions of dollars in a new image facility. You can see the results from our dealer survey. 48% of dealers expect their real estate and property investment requirements by the OEM will actually have a negative impact on future profits. Dealers nearing retirement want to avoid money-losing investments and are instead deciding the time is right to sell and let the buyer deal with having to build a new facility. And this is especially true as trust in OEMs in general is on the decline. We find that in part that's because so many dealers invested hundreds of thousands, in case millions of dollars in EV infrastructure and equipment that may become completely obsolete by the time the EV market share actually grows to a level where the equipment can be used. And that has left a lot of just in general distrust in these dollars that OEMs are asking dealers to invest in their facilities. Okay, now that we have discussed the buyers and the seller's perspective on the buy-sell market, let's talk about blue sky values. Like tariff calculations, there can be more art than science that goes into the value of a dealership. And much of the valuations are based on expectations for the future, which of course is harder to predict in today's environment. One thing is for sure is that franchises with the highest trust levels also have the highest valuation expectations and multiples. As you can see here from the results again of our dealer survey, the higher the trust, the higher the valuation expectations, with Toyota and Lexus leading the pack, in part because dealers truly do trust that Toyota and Lexus will do what is best not only for the OEM, but also for the dealer. And thus they are willing to make big investments in the brand, even in uncertain times. One way that OEMs are reducing trust levels with their dealer body is through excessive employment of their ROFR right. Not for the purpose, by the way, of improving the diversity of their dealer body, but rather to wedge their network into the hands of their favored sons and daughters. In our experience, the more an OEM ROFRs a franchise, the less buyers are willing to pursue these franchises, really wary of wasting time and capital on acquisitions they ultimately cannot close. While OEMs typically reimburse ROFR buyers for their transaction expenses, time and opportunity costs cannot be recouped. Recently, we have seen a significant rise in Hyundai and Mercedes ROFRing franchises. And it is not surprising to us to see that these two franchises also underperform their direct competitors when it comes to trust and when it comes to valuation expectations. Now, the final trend I'd like to discuss today relating to franchises is one that we also highlighted in our 24 annual report, the Blue Sky Report, and that is the importance of understanding your OEM's exposure to the Chinese market, which is the largest auto market in the world. While Chinese cars will not likely come to our shores anytime soon, most of your OEMs operate in China, and their historical success in that market was both very lucrative and helped fuel the rest of their global business. Unfortunately, that gravy train is coming to an end as legacy OEMs rapidly lose market share to homegrown Chinese competitors. Seeing this share cut in half in just 5 years, you can see that 2020, these the OEMs that weren't based in China had 64% of the Chinese market. And last year, it shrunk to 36%, and it continues to decline. The implication of this lost profitable market share for each OEM is significant, particularly the OEMs on this chart who derive the highest share of their total vehicle sales from China. You can see that GM last year was 40% of their total sales were out of the Chinese market. The China reshuffle will have significant financial implications for these companies and could start to impact blue sky values here in the US. By way of example, GM took a $5 billion write-down last year on its China business, which represented 70% of its total net income for the year. We encourage all dealers to keep abreast of how their OEMs are doing, not just here in the US, but also globally, particularly as you develop your strategic plan for where you're investing and how you're planning your business for the future. To wrap up this webinar, you will find here our blue sky multiples from our fourth quarter report, which we do not expect to change much until we have greater clarity on tariff implications. Now, last quarter, we increased Lexus's high-end multiple, which now surpasses Porsche to become the highest blue sky multiple of any franchise in the industry. 70% of dealers surveyed by our firm have a high level of trust in Lexus due to its superior business model. Think the highest UIO count, one of the highest in the industry, luxury or non-luxury, high sales per franchise, and superior gross profits as a result. We find that buyers will pay top dollar to add this franchise to their network and are actively seeking it. This quarter, Kerrigan Advisors also downgraded 2 luxury franchise blue sky multiples, specifically Audi and Volvo. In the case of Audi, the franchise experienced the steepest decline in sales in the luxury segment in 24. As a result, buyer demand for the franchise weakened, driving blue sky multiples lower. Likewise, Volvo saw its sales decline in 24, with the OEM's significant investment in EVs really kind of calling into question the franchise's future product pipeline and its suitability to the U.S. consumer. In the non-luxury segment, we increased the blue sky multiple ranges for Toyota and Kia. Toyota continues to reign supreme in the buy-sell market, commanding ever higher blue sky multiples as a result of the strength of its business model, much like Lexus, of course. Kia likewise continues to see high buyer demand as a result of sustainably high dealership profitability. Nearly a quarter of the dealers surveyed in our survey of 600 dealers were seeking to add Kia, and that ranked it 4th amongst all franchises that buyers were looking to acquire. Kerrigan Advisors also downgraded 2 non-luxury franchises this quarter. Specifically, we downgraded Stellantis and Nissan, which will be probably of no surprise to anyone on this line today. 2025 will certainly be a pivotal year for these 2 franchises as they navigate a changing auto retail marketplace and seek to right their ships. In the case of Stellantis, new management appears to be charting an improved course to reduce inventories and increase dealership sales and profits. With Nissan, the OEM's economic future will really rely probably on the selection of a business partner or merger candidate that, if successful, could strategically launch the company into a prosperous and more predictable path, which would have a meaningful impact on future blue sky values. In closing, President Trump once said, "No dream is too big, no challenge is too great, nothing we want for our future is beyond our reach." I think he had car dealers in mind when he said this, because I'm quite confident that no matter how this tariff negotiation plays out, dealers will continue to find a way to succeed, because you always do. It will certainly be exciting to watch. Thank you for tuning in to this rapid fire webinar on what's going on in the buy-sell market. Please do not hesitate to reach out with any questions about the presentation, Kerrigan Advisors, or our Blue Sky Report. I am always very happy to have a personal and confidential conversation with all of you. Thank you again, and thank you, AIADA.
Thanks so much for joining us today, Erin, and sharing this great information. We always value your insights. Again, you'll all be receiving this presentation and recording by the end of this week. To those on the line, join us back here next Tuesday, April 29th at 2 p.m. Eastern, as Strategic Source talks best expense categories to reduce costs and improve profits. For more information about AIADA, visit aiada.org. Have a great day, everyone.